Investors today, you're just drowning in information, right? Especially during earnings season.
Oh, absolutely. Pages and pages of transcripts, numbers flying everywhere.
It's a lot. How do you cut through that, find what really matters?
It takes focus. You need a way to filter out the noise.
Exactly. And that's what we're aiming for here. Welcome to this deep dive.
Today, we're unpacking the recent Q1 2025 earnings call from Shift4.
Yep, the payments and software company. We're going to guide you through the key takeaways from that call.
The numbers, the strategy insights from management, their outlook.
Our mission really is to get you the crucial info without you having to wade through everything yourself.
So let's kick off with the headline numbers for Q1 2025. Generally strong results.
Very strong. Volumes processed were up, 35% year over year?
Yeah, hit $45 billion. Solid growth there.
And that key metric, gross revenue less network fees, grew even faster. Up 40% to $369 million.
Right, and profitability looked good too. Adjusted EBITDA was $169 million.
Which is a 38% jump from last year.
And that gave them an adjusted EBITDA margin of 46% for the quarter.
Which was actually a bit better than they guided for, wasn't it?
Just slightly. They guided 45%. So yeah, 46% is a beat. Adjusted EPS came in at $1.07 per share.
Okay. And the overall vibe from management on the call?
Definitely confident, focused on execution. They basically said results were in line with what they expected.
And they felt good enough to actually raise their full year guidance for 2025.
Yeah, that's a pretty strong signal.
They also spent quite a bit of time talking about the resilience of their business model.
That was interesting.
Yeah.
Not just that it holds up, but their view that it becomes more valuable in uncertain economic times.
That's a bold claim. How does a company like this actually benefit from uncertainty?
Good question. So let's dig into that. What's driving these results and, way do they see things going?
Right.
Management points to a few things. First, their strength in specific markets, restaurants, hospitality, stadiums, places where they're often number one or two.
Right, they listed some big wins there. Aspen Hospitality, the SkyTab Hotels.
Major sports teams too, Pirates, Rockies, even huge events like the F1 Miami Grand Prix and the PGA Tour.
So market penetration is key. But what else?
A really big part of their story is M&A, mergers and acquisitions.
But not just buying growth, right? It's more strategic than that.
Exactly.
Yeah.
They acquire companies for their capability, sure, but critically, for the customer base, they can then cross-sell their core payment services into.
Okay, so they buy, say, a restaurant software company.
Like Revell Systems, yeah.
And then they go to those existing Revell customers and push Shift4 Payments.
That's the playbook. And they emphasized how much last year's wins are contributing now. Those deals are seasoning, as they put it.
So the deals take time to ramp up and contribute fully.
Precisely. That large volume of wins they talked about previously is now hitting its stride in the numbers.
Makes sense. So this acquisition and cross-sell thing feeds right into their main priorities.
It does. Priority one is pretty straightforward. Keep executing that core playbook in the U.S.
Add merchants, get more payment volume from the ones they already have.
In restaurants, that means signing up places for their SkyTab software, launching new hardware like the SkyTab Air handheld.
They mentioned Nando's, the restaurant chain, as a good example of SkyTab scaling up.
And in hospitality, it's adding hotels, but also really focusing on cross-selling payments to existing gateway customers.
Like the Nantucket Hotel example they give.
Yep. And in sports and entertainment, they're moving beyond just the big leagues, adding places like Red Rocks Amphitheater.
Okay, so U.S. execution is priority one. What's two?
Priority two is unlocking the value from those big acquisitions they made last year, Revell, Givex, and IEN.
Right, those three. How's that going?
They said they're making substantial progress on all fronts. This is where you really see that M&A strategy in action.
Acquiring specific capabilities, restaurant software from Revell, gift cards from Givex, gateway tech from IEN.
And then tightly bundling their own payments with those assets. It's less about cost cutting, more about acquiring a customer relationship and driving new payment revenue.
Can you give us some specifics on how that's working?
Sure. With Revell, acquired last June, they already have over 7,000 locations implementing Shift4 Payments.
Wow. Okay. That's pretty quick progress.
And they've integrated Revell's features into SkyTab, making it more competitive for bigger restaurants.
What about IEM, the gateway?
Acquired last November, They've already cross-sold payments to about 100 large customers who were just using the gateway before, plus integrating the tech.
And Givex, also November.
Yeah, its gift and loyalty features are becoming the default in SkyTab. They started that cross-sell push in February, already brought about 100 Givex merchants onto Shift4 Payments.
And that integration lets them replace some of their own older stuff too.
Exactly, streamlining the platform.
Okay, that covers the acquisition integration.
Right.
What's priority 3?
Accelerating international expansion, taking that successful U.S. model global.
They mentioned going from 1 continent to 6 pretty rapidly.
Yeah, less than 2 years. They've recently launched in Latin America, already signing enterprise clients.
And Europe.
Yeah.
They see a big opportunity there.
Huge, especially UK, Ireland, Germany, where bundled software plus payments isn't as common yet. They're signing up over 1,000 international restaurants a month now.
So they think the international market looks like the U.S. did maybe 15, 20 years ago.
That's the analogy they used. Fragmented. Separate providers for everything.
And they believe their integrated bundle is the answer merchants there are looking for.
But it has to be properly localized, local settlement, local payment methods, good software, not just a tacked-on payment option.
And it seems to be working. About 1 in 4 new merchants are outside the U.S. now.
That's what they reported, yeah.
Okay, beyond those priorities, they also talked about the pending Global Blue acquisition.
Right. Announced back in February, this looks like a pretty major future growth driver.
Tell us about Global Blue. What do they do?
They're big in luxury retail globally. Their main thing is handling VAT tax refunds for international shoppers. But they also do dynamic currency conversion. They have relationships with tens of thousands of high-end merchants and millions of international shoppers.
Luxury retail, though. Wouldn't that be a bit shaky in uncertain times?
You might think so, but management highlighted the resilience of luxury spending. Affluent consumers often keep spending.
Fair point. So what's the angle for Shift4?
The cross-sell opportunity, it's massive. Taking their integrated payment solution into Global Blue's huge merchant base.
How massive?
They estimate the potential payment volume just within that existing Global Blue network is over $500 billion.
Wow. Okay, that's significant. Are they confident they can actually capture that?
They seem very confident. They're targeting $80 million in revenue synergies by the end of 2027, mostly from that cross-sell.
And they called that $80 million target modest.
Yeah, suggesting there could be upside if they execute well, given the sheer size of the $500 billion potential volume.
And big existing shareholders like Ant and Tencent are staying involved.
Expected to, yes. And collaborating on e-commerce opportunities. The deal itself is tracking for an early Q3 close, pending approvals.
Okay. Circling back to that resilience theme, management kept emphasizing their history.
They did. Repeatedly mentioned growing volumes every single year for 26 years. Through COVID, the financial crisis, recessions.
That's quite a track record. It definitely backs up their confidence.
Absolutely. And they explicitly said they welcome uncertainty.
Because their model gets more valuable then.
That's the argument. The product lines, the economics, that huge cross-sell funnel, it all becomes more potent when things are unclear.
But they're not being naive about it.
No, they qualified it, not rose-colored glasses, but operating with an abundance of caution and a mindset of paranoia. Quite the phrase.
Indeed. Okay, let's maybe touch on a few more financial details from the CFO, Nancy Disman.
Sure. She reiterated Q1 was a record first quarter across all their key metrics.
Right. And while the Q1 margin was 46%, they expect that to climb through the year.
Yeah, as those acquisition synergies really kick in. She noted that without the temporary drag from integrating those recent deals, Q1 margins would have been closer to 50%.
So that shows the underlying potential.
Exactly. And they expect better operating leverage as they add more payment volume through cross-selling and work through their backlog.
What about spreads, the rate they earn on volume?
Came in at 61 basis points in Q1, right in line with guidance, stable with late 2024. They still expect around 60 basis points for the full year.
And the subscription revenue looked strong.
Very strong. $93 million, up 77% year over year, driven by SMB, SkyTab, Sports, and the acquisitions.
There was a slight dip from Q4, though.
Yeah, but expected.
Yeah.
They're intentionally deprecating, basically replacing some older revenue streams from acquired companies as they move customers to the main Shift4 platform.
Got it. And organic growth.
On track for over 20% organic revenue growth for the full year, Q1 was in line with that.
Okay. Cash flow.
Adjusted free cash flow was $71 million in Q1. That's a 42% conversion from adjusted EBITDA.
But that included a big interest payment, right?
It did. First big semi-annual payment on debt from last August, about $37 million. Excluding that, conversion would have been much higher, like 64%.
And they're still projecting over 50% conversion for the full year.
Yes, that's the...
They were also buying back stock.
Yep. Repurchased about $63 million worth in Q1, and then another $85 million in April. Suggests they thought the price was attractive.
Any accounting notes?
GAAP net income was $20 million. Adjusted non-GAAP was $99 million, or 1.07 per share. They did clarify they're now adding back acquired intangible amortization to that non-GAAP figure, which aligns them with peers.
And the balance sheet, debt levels.
Pretty good shape. Debt cost is low, averaged 3.4%. Net leverage was about 2.4 times adjusted EBITDA. They have $1.2 billion in cash and feel ready for $690 million of convertible debt maturing in December.
Okay, so all this strong Q1 acquisition progress, confidence led them to update the full year guidance.
That's right. They bumped up the range for gross revenue, less network fees to $1.666, $1.73 billion.
Which is about 25% growth at the midpoint.
And adjusted EBITDA guidance also raised to $865 million. Similar growth profile, 24% to 28%.
And they gave Q2 guidance too.
They did. Expecting gross revenue less network fees between $405 and $415 million for Q2, with margins projected around 50%.
Okay. Thinking bigger picture, outlook.
Yeah.
How are they seeing consumer spending?
Within their specific verticals, they see stability. Q1 trends looked a lot like late 2024, maybe some minor monthly choppiness, but same-store sales are holding in a narrow range for restaurants, hotels, etc.
And crucially, their guidance doesn't rely on things getting better.
Exactly. They built it assuming stable trends continue, operating with that abundance of caution.
Most of the growth they expect comes from deals already done.
Yeah, annualizing past wins and converting that big backlog of signed deals, that backlog is huge, $35 billion now.
$35 billion signed, but not yet live.
Yep. Up from $33 billion last quarter. They think maybe $25-30 billion of that gets implemented over the next 12 months. That's the main growth engine.
Not really dependent on same-store sales jumping or landing tons of new deals this year.
That's the message. It's embedded growth.
They also mentioned the CEO transition briefly.
Right. Taylor Lober set to take over from Jared Isaacman, assuming Isaacman's potential NASA nomination goes through the Senate.
And Isaacman stays as largest shareholder, standard voting rights.
Correct. Senate ethics didn't require him to sell his shares.
Okay, anything interesting pop up in the Q&A part of the call?
A few things. On international, they just reinforced that their advantage is that software plus payments bundle, which isn't common abroad yet. They feel merchants are clamoring for it.
And confirming macro trends.
They specifically said April looked like more of the same. Very consistent trends within their base, despite wider economic noise. No real change.
Doubling down on that backlog, driving the guidance.
Exactly. It's the engine, more than predicting consumer swings.
How's the cross-sell from acquisitions progressing?
Revell going very well. Vectron helping international growth. IEN, newer deal, but showing progress too.
What about branding? Do they keep the acquired company names?
Generally, no. They sell under the Shift4 brands now, integrating the acquired tech into their core offerings like SkyTab. The old names fade.
And confidence in Global Blue.
Growing, they said. Especially noted the cultural fit focusing on things they can control, like product, not just relying on travel trends. They think the business is more resilient than it looks.
They also explained that dip in software revenue again.
Confirmed it was planned replacing legacy acquired revenue as they migrate customers. Expect overall growth there, maybe moderating slightly.
Confidence in EBITDA outlook sounds high.
Very. Citing Q1 performance, stable trends in their base, cost discipline, and acquisition synergies kicking in.
And pricing strategy.
For big clients, it's competitive but reflects bundled value. For smaller businesses, more variable costs, lower fixed fees, stable spreads, which they think works well if merchants get price sensitive.
Finally, capital allocation. Buybacks mean they like the stock price.
Explicitly said so. Ideal use is still R&D and strategic M&A capabilities, customers, geography. Global Blue might open doors for more international M&A down the line.
Okay, so wrapping this up, what does this all mean for you, the listener?
Well, this deep dive really shows a company, Shift4, that's executing a very clear strategy.
You heard about the strong Q1 numbers, volume growth, even faster net revenue growth.
Supported by stable spreads and that booming subscription line helped by acquisitions.
And we zeroed in on those three core priorities.
Yeah.
keep winning in the U.S.
Unlock value from Revell, Givex, IEN, through that bundling playbook.
And really push that international expansion in places like Latin America and Europe.
And a key theme, a constant thread, was that confidence, rooted in their history of growing through thick and thin.
Right, that 26-year track record. They don't just endure uncertainty, they think their model gets better.
But with caution, guidance assumes stable conditions, not improvement.
And that pending Global Blue deal looks like a huge potential future lever luxury retail access, massive cross-sell.
Plus, you got insights on the CEO transition, capital allocation, those recent buybacks.
So understanding these drivers, that integrated software plus payments power, leveraging acquired customers, the resilience mindset gives you a much clearer view of how Shift4 operates and plans to grow, whatever the economy does.
So here's something to think about. Given Shift4's explicit strategy, using uncertainty, using consolidation, driving M&A and cross-selling, how does that really stack up against other companies you follow?
Especially in payments or software. Does a business model designed to thrive in volatility change how you think about those sectors overall?
It's an interesting question to ponder.
Definitely. Thanks for joining us for this deep dive. We hope breaking down this earnings call transcript was valuable, helped cut through the noise.